Special guest on the show today, Saurabh Mukherjea, Chief Executive Officer at Ambit Capital, joins us right now on the show. Saurabh, good having you as always. Thanks for taking the time out. I'm looking at your thoughts that you've shared with us, Ambit Capital thoughts and exhaustion signs visible in the market. Why do you believe there is exhaustion? And what are the signs that are leading you to believe that the market could be tiring out?
I think whenever you see a big surge of QIPs after a long upward rally in the market, whenever you see a big surge in QIPs, and especially QIPs from less than ideal companies, it does raise some questions about the quality of the rally and the quality of the paper coming to the market. So it could well be that we have an earnings turnaround round the corner, but at this juncture it does feel like we have an overstretched market, overstretched on the valuations front. And whilst, as we've been saying over the last 3 weeks since the banking recap was announced, whilst there's reason to believe that next year growth will pick up, GDP growth will pick up to around 7%, and earnings growth next year might well be the first year in 5 years of double-digit earnings growth. Even considering 15% earnings growth next year, you got a market which is pretty fully valued, more than fully valued, I would say, and hence the view that from a fundamentals perspective, you got an overstretched market, and on the quality of paper coming to the market, especially on the QIP front, you got some really smelly stuff hitting the market.
You're talking about QIPs, but if you look at some of the recently listed IPOs, in fact, these have been some companies waiting to enter the primary market for a long time. Some of the leading companies in respective sectors like insurance, mutual fund, or even retail. Are you really worried about the quality in the primary market on the IPO front as well?
I think the primary market, the IPO activity has been sort of mixed. You had a few good companies mixed with several ordinary ones. What is noticeable is high quality B2C, high quality manufacturing companies. We haven't seen that many. I think since that memorable DMart IPO, there are not that many names come to mind as really frontline plays on the manufacturing segment or the B2C segment. Good news is on the life insurance front, we've had several stellar champion players in life insurance come through. So if you ask me, IPOs is a mixture of mediocre and some really high class names. But the QIP front the QIP names do look worrying. These are companies which have been trying to raise money for a while. The fact that they've got a window now to raise money and they're sort of obviously printing the dollars as quickly as they can, it does raise the question as to about the quality of paper hitting the market. Alongside that, you've got overstretched valuations, a little less overstretched than before the PSU recap, but even then, barring a remarkable pickup in earnings next year, barring a sort of absolutely miraculous pick in earnings next year, you've got an overstretched market. Alongside that, for reasons that India can't control, oil is picking up. Oil picking up, going through $60 is always a concern for us because of the impact that oil has on our economy, given that we import almost all of our oil.
Yeah, you preempted my next question, Saurabh. You combine valuations, politics, and macros really well. Two factors that I wanted to ask you about. One, the crude oil uptick. You gave a brief, but if you can elaborate there as to at what levels would crude start really concerning you, if not already, and what facets within the market would really be at risk, if at all. And two, there's of course this very interesting political arena game, so to say, over the course of the next 35 or 40 odd days. How would that play a part in market mood, if at all?
I think last time I was on your channel, I remember that was the day, or the preceding day, the government had cut excise in order to compensate for the rise in the oil price. So the oil fuel is still deregulated in our country. Petrol and diesel is deregulated, which means that dollar for dollar, the rise in crude will, with a 2-month lag, hit our economy. And given that we've got 14 elections in the next 17 months, it'll be a big test of the government's conviction on the reform front, whether to regulate oil. If oil goes through 70, if crude goes through 70, and this government doesn't bring subsidies back in, I think it'll be a huge huge sign of their commitment to reform. So fingers crossed on that front. I think that's a big test that's coming up. Crude going potentially through 70, and India being asked a question: do you still want to keep deregulated oil going? But the broader piece is, if you look at the last couple of years, we've pulled off something which is quite miraculous. You had GDP growth falling for 6 quarters. You had falling interest rates, and in spite of that, both on the bond and the equity front, FII money has come into India. That's never happened before. Falling GDP growth for 6 quarters, falling interest rates, and in spite of that, lots of FII money, bond and equities. That's a one-off. The reason we pulled that off was inflation was low, and inflation was low because commodities were cheap and the fisc was under control. Both of those factors, commodities and fisc, could go the other way now in the next couple of years as we approach the 2019 elections, and hence I think it's worth being circumspect on overall market positioning. Yes, I do agree that the recap of the PSUs does give you a chance to play cyclicals. Excluding BFSI, I think cyclicals will have a decent run as global commodities rally. But on the overall market level, I continue to believe we have a fully valued market.
But interest rates is the factor that most of the analysts have been mentioning whenever we talked about stretched valuations. You are actually hinting at a resurgence of inflation, but do you think it's going to be significant enough for RBI to really think of a rate hike going forward? Because I think the consensus view is that we are in a stable interest rate scenario, maybe a cut in future if things kind of turn in our favor, but hike is something that nobody's talking about.
Well, when people don't talk about something, when consensus is blindsided about a risk, that's when you should focus on the risk. But to put it in more practical terms, as I was saying, the reason we've been able to keep inflation at around the 3-4% mark, CPI inflation, is because we've been helped by the commodity cycle, and we've also been helped by a government which has been fiscally prudent. So a lot of credit to the NDA. First 3 budgets for fiscally conservative, prudent budgets. But as we all know, the fisc is under a degree of pressure now. GST collections are below par. The PSU bank recap bill, unless the RBI picks up the PSU bank recap bill, the PSU bank recap bill will stretch the fisc on any normal definition of a budget deficit. So if you look at a stretched fisc plus the PSU bank recap plus rising commodities, it'll be absolutely miraculous if CPI didn't start pushing towards 5%, given all that backdrop. And hence, I think the conservative investor, the cautious investor, should start seeing this as broadly the bottom of the rate cycle. Maybe just in a really exceptionally positive circumstance, we have one more rate cut. But I think the odds are growing in favor of rate hikes rather than cuts over the course of 2018.
Calling it early, maybe. Okay, Saurabh, I probably have one final question, really. I was just looking at all that Ambit Capital has come out with in terms of thoughts over themes and sectors. And that one that stood out for me was your recent turning bullishness on select brokerage stroke NBFC names. Now, we've had the 3 large listed players come out with the results. The market correction has come in maybe because of higher valuations, but I think there was a common theme across all 3 discussions that we had, was that all 3 mentioned that the growth rates that they have showcased in Q2, from the looks of things, could well last out until FY18, maybe even beyond. The question mark only sort of to my mind is whether the valuations out here too are stretched or no. What would your thoughts be?
I think, look, if you were to take the market as a whole or even brokerage stocks, it's unquestionable that on a 1-year view, even 1.5-year view, I think we are fully valued in this country at the moment. The difference with brokerage stocks, which doesn't apply to the market as a whole, the difference which does apply to the really high quality brokers, especially those who have very little NBFC business in their book. I do worry about brokers who also try to become NBFCs. I don't think they have any business doing it, but that's their prerogative. But if I look at brokers who don't have big NBFC housing finance books, the reason I like them is I think real estate in India is heading for a major correction. We've already seen a correction in real estate prices across the big cities in the last 3 years, but with growing evidence that land price deals are being struck at cut price rates, and with anywhere between 4,000 to 7,000 companies in the NCLT process, I think we can look forward to a major correction in land prices, and by one remove real estate prices next year. So therefore, given the increasingly grim outlook for putting money in property and and land, I think increasingly Indians will shift to putting money into the financial system, for which the brokers would benefit. Does that necessarily mean a stock price rally for the market as a whole? I'm not so sure, because lenders account for 35% of the Nifty's weight. No sector ever has accounted for 35% of the Nifty's weight, and I think the rally in lending stocks is overdone. But brokerage companies, wealth management companies in India, I think have a long growth runway ahead of them, as Indians stop saving through physical, land, real estate, and increasingly save through financial assets, bonds, equities, mutual funds, and so on.
And what's your take on the overall consumption story? Auto is one prominent sector that has been doing well. Select names at least have kind of outperformed market expectations. What's your view going forward?
I think on consumption, the big unknown that we're trying to assess is, has there been in effect a stealth GST cut, in the sense that at the lower end of the spectrum, the 1.5 crore and below turnover companies, are they really paying GST, or are they basically operating in broadly tax-free regimes? Tax-free, obviously not de jure, tax-free de facto. And if that's the case, if for the small trader, for the SME below with 1.5 crores and less of turnover, if the GST regime is lax, slack, etc., then I think through the winter consumption could pick up. But it's still hard to gauge it, partly because every weekend these GST rules change. So the business community itself doesn't know, that even the chartered accountants aren't fully on top of what's happening. But if, given the imminence of 14 elections, the fisc decides to take it easy on GST collection, then I think SMEs might well be able to drive consumption through the winter, as they realize that GST isn't that much of a horror show that they thought and we thought it would be.
Okay. On that note, Saurabh, always a pleasure talking to you. Thanks so much for taking the time out, and we'll watch out for that caution as well as the rate cycle trajectory as well.